This content is for informational purposes only. You should not construe any such information or material as legal, tax, investment, financial, or other advice. Nothing contained on here constitutes a solicitation, recommendation, endorsement, or offer by Draper Goren Home or any third-party service provider to buy or sell any securities other I'm like butchering this. There's so much to say. Let's start from here. Nothing contained on here constitutes a solicitation, recommendation, endorsement, or offer by Draper Goren Home or any third-party service provider to buy or sell any securities or other financial instruments whatsoever. And we have an amazing media partner, Blockchain Radio, where you can catch this recording afterwards on their network, and as well as our YouTube channel, Draper Goren Home. And without further ado, today's topic is all about liquidity pools. That's a mouthful for me, and I butcher it every single time. So cheers to that, because we are on Blockchain and Booze. Curious, what are you guys drinking, if anything? This is the booze part of Blockchain and Booze.
Coffee for me, because I don't drink.
All right.
Coffee as well for me.
Coffee. You guys are boring. Dave,
we're the worst board for Blockchain and Booze, Adam.
what is going on? Are you drinking anything?
Designated driver.
Well, one of those nights got to stay up late, and Booze are going to put me to sleep, so gotta do the opposite.
All right, everyone's building tonight. All right, no worries. Okay, so without further ado, liquidity pools, okay, or liquidity in general, for that matter, is seen as this king, right? It can either make or break your protocol. So let's start very simple. David, we can start with you and work our way down to Kevin and then Corey. Kind of take us through how you define liquidity pools and really how they work.
Yeah, big task here for the audience. Yeah, I mean, liquidity pools, I guess, really started with the concept of automated markets in general. Uniswap is obviously a really big brand name that everybody can relate to, and we can talk about openly pretty easily. So yeah, I mean, Uniswap really helped define this concept of liquidity pools. I mean, they're the simplest automated market out there in their algorithm of X times Y equals K for price discovery of assets. And that's really at the core of how a liquidity pool is created. You can provide liquidity to a Uniswap pool by depositing both assets in that market in equal ratio. And then you can get, in return for supplying that liquidity, you get a deposit share, or an LP share as people call them, which can be used to yield farm or used as collateral on other platforms. So if just as an example, if you have Ethereum and DAI, and I can go in right now and just checking on prices I could put in about 420 DAI and equal amount of Ethereum into a pool, and then I'll get back these LP shares, which represent my share of this liquidity pool in Uniswap, and then I can use that as collateral on other platforms. So that's kind of the basis for what's going on here at a high level. And for supplying that liquidity, there's you earn fees in that pool. So when people come and trade Ethereum for DAI, you're earning the fees for that exchange by being a liquidity provider of those assets. One of the biggest drawbacks, or I would say criticisms of liquidity pools, is impermanent loss, where arbitrageurs will extract value from your gains or exaggerate your losses through the assets that you provide to this liquidity pool. Without going through the math and the whole sort of what that entails, basically by providing these liquidity pools, you will lose out on the opportunity on some of the upside of your assets if the value of those assets that you provide goes up. And if the value of the assets in the liquidity pool goes down, you'll lose even more so than the lost value from them going down. So in the best case scenario for liquidity pools, you supply two assets at their market value into a pool, and then when you withdraw them, they're at the exact same value at which you supplied them. There are a couple projects out there that are trying to limit the problem of impermanent loss in automated markets and liquidity pools. These are names like Balancer, Dodo Finance, several others. I mean, it's a little controversial because some say that they're not really improving the situation. Some would argue they are. depending on how you look at it and when you're actually calculating the ROI on your investment to liquidity pools. But anyways, I put a lot of information out there. I guess I'll just stop right there.
It's a very expert point of view kind of thing, very complex, sophisticated point of view. And also introduce yourself, because we kind of skipped that part.
Sure. I skipped that part, the boring stuff.
Right.
I'm David. I'm the founder and CEO of Totle. We work on DEX aggregation or order routing for decentralized exchanges. Basically, some of the names I just described, plus many more that are not automated markets or liquidity pools. We aggregate all of the decentralized exchanges on Ethereum to find you the best price for swapping your assets.
Awesome.
And so that's what our organization's focused on, and how I have so much intel on the liquidity pool and automated market space, I guess.
Awesome. Kevin, talk to us about liquidity pools. What are they from your perspective? And also, I guess, from the Tezos perspective as well. And how do they work from your point of view?
Yeah. Don't forget to introduce yourself.
Yeah. Well, well, just to continue on what was saying, I don't want to interrupt that flow, but I'd say the model can be seen as pretty standard. It's not like it means something necessarily different under Tezos. And that's, I think, kind of the beauty of the simplicity of it. We have Dexter now, dexter.exchange. Anybody can go to that. I'll put it in the thing. And then we have a new one coming up pretty soon and that'll be the second on Tezos, and that'll be QuicklySwap. So dexter.exchange, and then QuicklySwap.com. Okay. And same process. You deposit tokens 50-50 in value to a particular pool. That pool represents a particular pairing, like say XTZ Tezos and USD Tez, which is the coin that I founded and the team I work with works on, and TZBTC and XTZ, and that's another team that's between Bitcoin Suisse and some other firms out in Europe. And we have more on our timeline coming up to follow USDTZ. There's ETHTZ, there's BTCTZ, so some more offerings are coming out pretty soon. Also, in addition to these exchanges, we will be putting out Tezex.io, and at first it would be a bridge, actually, which would connect the Ethereum markets you mentioned, David, like Uniswap. Curve is another one I like to frequent a lot when I'm on Ethereum, trading Ethereum tokens. It'll bridge those tokens, the ERC20s, over to the Tezos standard tokens, which it's ERC20 and Ethereum. For Tezos on its standard, it's FA, FA 2.0, FA 1.2 versions of that in the same kind of format. Oh, very mature.
Smooth, David.
So, yeah.
So Kevin, awesome. So tell us a little bit about your project also, really quick. Give us a quick introduction about yourself.
Yeah, so USD Tez is the first product coming out of StableTech. And StableTech is a coordination of DeFi projects that are to be the primary layer of DeFi projects coming out under the organization between WealthChain, which is my company, Cryptonomic, which is a leader in the space in Tezos. They have the most popular wallet, Galleon Wallet, which is available on all platforms. TokenSoft, which is a leader with regard to security and compliance, regulatory frameworks, all of that. And they're just really great with integrations, and have been like a fantastic partner as well. We also just announced, I guess, a month ago now, Draper Goren Home coming in as a partner. So glad to be part of that family.
Yes. And
yeah. A question about the Tezos, if you don't mind jumping in for a second. So how does the platform work for DeFi? Is it I'm just less familiar with Tezos. Is it a sharded blockchain where you're going to have a DeFi sort of parachain zone or whatever you want to call it, or is it more equivalent to an ETH1 design where there's one chain that you're working off of for things like DeFi?
Yeah, it's one blockchain. Yeah.
Got it.
And yeah. And the FA token standards, those are going as Tezos improvement proposals. Actually, I think the acronym is slightly different for a confusing reason. No, I think I got it right. Doesn't matter. But yeah, you can see that on the TQ Tezos site. TQ is for Tocqueville Group. It's tqtezos.com, I believe. Yeah, so and there you can do documentation about the FA standard, what all the improvements that have been coming out and will come up, how they reflect kind of equivalent to Ethereum. So I think what's great about right now coming in for Tezos as second mover, if you want to say, is the benefit of those inroads having already been made by the Ethereum ecosystem. That people, back then it was new, and everyone, the learning curve just took so much longer just because. That's just the nature of things. But now it's like, okay, got it. Everyone knows what they're looking for because they've already not only come to understand it, but use it in not just trading for on Uniswap, but for lending systems, Compound and Aave on Ethereum, and like liquidity pools on the exchanges like Uniswap, like Dexter. You have lending pools, borrowing pools, which some people might speak of them interchangeably with liquidity pools. In my mind, there's liquidity for, just for the sake of organization, there's that, and then there's lending pools when it comes to these types of lending systems. So those are automated interest rate makers in which they use the demand and supply forces to figure out a utilization ratio, which translates into an automated interest rate that accrues, and the users are expected to remit, and if they don't, there's collateral that they put up. We're working on a system on that for Tezos, and that's tezos.finance. So that'll come out relatively soon. I guess the two parts of what we're doing, I'd say it's the asset stuff and a method to transfer them, and then the lending stuff, which is Tezos Finance. I think that's a key. Those work very interactively with the liquidity pools on the exchanges as well. Because if you're a user, if you're providing to these pools, or you're thinking about doing it, you're looking at what's going to give me the biggest yield. And sometimes it's a matter of, okay, do I put it in this liquidity pool, this thing on Uniswap, or do I put it in this pool on Compound to earn not by transaction fee, but by interest earned from people borrowing, or you're using them, interoperatively. You're putting collateral up to borrow so you can provide to a liquidity pool on Uniswap, or, there are just so many infinite combinations of things to do it. But I think the key thing, the way I see it, is that this is a framework. That framework can be used. There is another market type for something, another governance token for that marketplace. And then those governance tokens work together with stable coins to go on and make new types of liquidity pools and whatnot, and all the things that fall out of that, whether it's lending systems or derivatives. So it's a very complex web, but definitely I'm glad we're having this discussion, because liquidity pools are like just that cornerstone of everything. It really just does start here. It's like the most rock solid base to build everything else that will come afterwards. And the greater I think we do it, and the bigger we build them up on every platform. I don't care what blockchain at this point. It's just like, let's get it on chain. And then we can, expand and innovate in different types of platforms and systems later.
Yeah. Are there tools to use Tezos DeFi today in terms of like wallets that I can access, like Web3 type wallets and sites that are actively doing that, or is it testnet?
Yeah, there's Phanos Wallet. I believe.
Is that a browser plugin?
Works like MetaMask. See, we all know MetaMask, right? So just as easily we can skip that learning curve and adopt Phanos Wallet. I believe that's what it's saying. It's not somebody tell me. But there's also Beacon. If I don't mention the alternative sources, I'll be chewed out. So wallet, beacon.io. That's where I'm coming.
Kevin's just dropping resource bombs. I love it. Just to include Corey into the picture, Corey, why don't you go ahead and introduce yourself and kind of tag along to the initial question of liquidity pools, right? What are they? How do they work from your perspective, and sort of how DMM kind of views the use of liquidity pools and what you guys are doing?
Sure. So I'm Corey from the DeFi Money Market team, or DMM. I'm the CTO and essentially working on all things relating to their technology, from smart contracts, servers, APIs, high-level architecture of things, everything around that front. Really excited by the developments in liquidity pools, and especially the amount of liquidity that's also getting put into these liquidity pools as of recently. It's been very exciting on the DeFi front. I mean, my perspective on liquidity pools, to be honest, isn't that much different from David or Kevin's. Uh, I actually would group into them lending pools, even though we kind of give them a different name. I do kind of see them as a very primitive liquidity pool. As for our use of them, as well as what DMM is a simple yield earning protocol where you can earn interest on your crypto by depositing into a protocol, and we base that interest from loans against real-world assets that are tokenized and made available on-chain, made transparently available on-chain. So we're really excited by the idea of bringing stable and uncorrelated interest to the rest of the industry and all the participants that have been involved in it so far. DMM's use of liquidity pools is quite interesting because we have our own governance token, DMG, that helps, as the name suggests, govern our protocol. And we're all about trying to build up liquidity for it, as well as liquidity for the tokens that exist within our ecosystem. So right now, there's actually opportunities to stake your tokens inside of Uniswap pools, and those pools will actually spit out DMG for you as a reward for putting that liquidity there. That's a part of this of the move to include yield farming as a way to incentivize users to bootstrap growth in your own liquidity pools to essentially get it off the ground and solve the chicken and egg problem of liquidity. The chicken and egg problem being that you need liquidity to essentially get more liquidity. Now, people don't want to trade on a platform that has no liquidity, but in order to have liquidity there, there needs to be use of it. So it's very much like a back and forth kind of problem.
So let's kind of dive into that, right? It's a good place to continue the conversation. So elaborate more on this chicken and egg problem and kind of how you guys approached it, right? How do you kind of solve that issue?
I wouldn't even say that we solved it yet, but we're actively trying to solve it, just being honest. But yeah, where we're at with it right now is the way our ecosystem works, at least, is that there's a market between tokens that you want to earn interest on and the tokens that you're earning interest on. We call those tokens that you're earning interest M tokens. So you deposit DAI and you get M DAI. You deposit USDC and you get MUSDC. The M variant captures the interest that we pay out. And we're actually in the process of setting up Uniswap pools for them, such that you can trade actually between these M tokens and their underlying counterparts. The reason being that it essentially acts as a secondary reserve in case there's a liquidity crunch in either situation where there's a run on the bank or where there's excess demand. So there's actual need and use for it as our ecosystem matures. And what we're trying to do to bootstrap that growth for right now is, as I mentioned earlier, if you supply liquidity in a Uniswap pool for these assets, which are tightly correlated to each other, you can earn DMG in doing so. And if you value that DMG back to US dollars, you can calculate an APR for it.
Okay, awesome. I kind of want to throw a question out there because, David, you kind of touched upon this, and so did you, Kevin. So what are some of the major challenges that liquidity pools face outside of the chicken and egg problem that Corey just discussed, right? And I like that Kevin's here because he brings also a new perspective from the Tezos side of things, right? So how do the challenges differ when creating liquidity pools, right? Managing liquidity pools, ensuring that there's consistent liquidity across all tokens, across all pools, right? Matching pools. Kind of take us through that, David. You can start, and then we can bounce to Kevin.
Yeah, I mean, I think I kind of touched on it when I was rambling a little bit at the start there in terms of impermanent loss. I think impermanent loss is the biggest, I'd say, talked about issue in terms of liquidity pools. I mean, there's other things like we'll see in the chat. I mean, like rug pools and things, but that's really not having to do with liquidity pools themselves, more so with the actual token and the issuance of the token. It's more of an attack vector by just inflating and issuing a ton of tokens. But yeah, impermanent loss in terms of market makers or market suppliers of liquidity to the pools having impermanent loss or opportunity loss. And I would also say, this idea of a honeypot issue. So like, I guess that goes into insurance and to other things. But I mean, just the fact that you're pooling liquidity, by definition, you're increasing the economic return for a hacker who exploits, who can find an exploit in, you know, a line of code or in one of these pools. You're increasing the reward for them, so inherently increasing the amount of people and attacks you'll see on these types of things. I think that's opportunity more than it's a threat for things like insurance and things like Nexus Mutual and other programs that allow you to basically bet on the action of a hack or a loss. And so, yeah, I mean, those in my mind are really the biggest threats. I'd love to hear what the rest of the participants, Kevin, what you have to say about it.
You know, I think more the biggest challenge is education. I do think that, yeah, impermanent loss, especially because of the pro rata basis that people are looking for at increased frequency or shortened time intervals of keeping money in certain areas, particularly if gas rates are low enough to permit that more frequently. Like that makes it more of an issue to which people would actually prefer something that would allow for some constant growth, maybe not as like crazy or unpredictably advanced, but at least if it's constant. But those are packages that people will ultimately create who build on top of these things that are more long-term plays, things that rely more on law of averages and how you know, losses will balance out as the market moves in the other direction, but also faith that will happen too. So I think there's a lot of variety out there when you're choosing what pools to participate in particular, because these platforms are so open that any contract can be traded. And if any contract can be, any token can be traded, then any pairings can be made independently of whatever forces are necessarily behind those exchanges, for good and for questionable and for deception. So that's another issue that I think people can get played on in many ways. So that's something I think trust is going to be a big deal, being able to filter out where the quality, but also what's a come up, what's a worthy come up that maybe start to follow. And that's one of the reasons why I think Tezos DeFi is so appetizing to so many people now. That's just been growing in momentum that I've noticed ever since Dexter launched a month ago. It's that, oh yeah, this actually kind of simplifies things because there aren't all these yield options on Tezos yet. So, you know, great for entry level participation and an ability to maybe expand into those areas when they come into fruition. And then they're able to follow this as a journey. So, and with that, taking the lessons of Ethereum and things that maybe weren't so optimal in the past and improving on them, because we have the benefit of hindsight as we build out this brand new ecosystem. So, yeah.
Awesome. And David, you're working on or spearheading a really interesting project that we're also, Draper Goren Home is also involved with PrimeDAO, right? And maybe tell everyone that's watching, what is PrimeDAO, and also dive into this liquidity pool manager and what that kind of consists of.
Yeah, appreciate that opportunity. And also to build upon what Kevin was just saying about education, which is one of our, I guess we'd call mandates for PrimeDAO. I also see it as a re-education. Like, you know, you have all these people in traditional finance, and I see all the time, and they're always so interested in participating in DeFi. And the thing that they want the most, right when they start talking, is fast finality and high frequency trading and an order book. And really what I think is really crucial when talking to people from the traditional finance world, which was what PrimeDAO is all about, which basically at a high level, PrimeDAO is about providing all of the infrastructure components for a new financial system where there are no clearing houses or custodians. So just imagining what the needs are in a world of that dynamic, what we need to build and what we need to offer and how we can make this go mainstream. So that's really what PrimeDAO is all about. And we're chain agnostic. So we'll be looking at other things like Tezos and Polkadot and other forms, other chains and implementations for things, DeFi products that'll allow us to achieve these goals and offer DeFi to a wider audience. But that this re-education part, and that's really core to what I'm hitting on with Prime, is that we talk a lot in terms of Prime and Totle, but really with PrimeDAO, we're speaking with a lot of traditional finance folk who want to come into DeFi, and they really just aren't getting it at the start. I mean, it takes a lot. You really have to get in and use it. You have to get in there, use Uniswap, even if you're really not into it at first. You got to put some money into some pools and really realize what the value is in terms of composability. And I think I was touching on that right when we did the intro, in terms of taking your shares in this liquidity pool and providing them to other cool, borrowing or lending platforms or collateral and other things. That composability is really, in my opinion, the killer application for DeFi. And people who coming from the traditional finance world can't get out of this bubble of, I really need to just have an order book and have fast finality, and that's all that really matters. The truth is that the value is created differently in DeFi, and it looks different and it feels different. But just because it's different doesn't mean that it's bad or that it's less efficient. You just have to actually learn to play this new game rather than trying to be so focused on this previously, accepted traditional finance game where market makers have all the power or certain centralized parties have all the power, where in a new, the envisioned new decentralized finance system, there aren't centralized power entities like Goldman Sachs or JP Morgan. It's a level playing field, and that's what liquidity pools provide, right? Anybody can come in with, let's take away the gas fee issue for a minute here. Anyone can come in with $1, $5 and participate in a level playing field with professional market makers. And so, I'll leave it with the last thought. I'll throw it to Corey, who hasn't had a chance to jump in on this part of the conversation. But really just the fact that I find it kind of funny when traditional finance individuals, kind of start ragging on automated market makers, AMMs, and they're market makers in the traditional finance world. It's like, if your job had the word automated before it coming into now fruition, yeah, you'd be upset too. So this concept that market makers are being disrupted, I think we're going to see a lot of traditional market makers get frustrated with what the value add is for them and for the world with DeFi.
Yeah, those are all very fair points. I think something that's very interesting, which I wanted to touch on a bit more, is the composability that was being alluded to earlier and what this really looks like. You'll probably see a lot of headlines, especially as of recently, that decentralized exchange volume is now down 25% this month, in different big figures like that. But a lot of people don't necessarily realize why there was so much volume in the first place and why it might have gone down. A lot of the volume that actually came into decentralized exchanges actually came from the concept of yield farming, which has been alluded to a number of times by myself and other people, David and Kevin here. And just taking a step back of what this yield farming thing is and how it actually contributes to volume is a very interesting concept. And then it kind of ties together this entire composability narrative, which is, right now platforms like Uniswap are actually offering people free Uni, which is Uniswap's governance token, which has some value attached to it, for providing liquidity for ETH against other major quote currencies, like DAI, USDC, I think USDT as well, and then WBTC or wrapped Bitcoin. And what protocols have done, which have basically built on top of this mechanism, is the ability to automatically take the Uni that's being distributed to you and sell it, and then once it's sold, convert it back into your original currencies, essentially adding it to your portfolio, amplifying your APR. So whatever it is that you're earning from being a liquidity provider, you're now also earning additional APR on top of that by automatically selling that Uni and into the original currencies. So what we've seen is, if people in here have heard of Harvest Finance or YFi or YEarn, these are very large protocols that overnight accrued cumulatively hundreds of millions of dollars, and at one point over $1 billion worth of value. And continuously they were pumping out 10 or 20% APR, sometimes more than that, way more than that. And when that was happening, what they were actually doing behind the scenes was contributing massively to decentralized exchange volume, because behind the scenes what they were continuously doing was selling Uni or selling Curve or other tokens governance tokens, mind you, back into original assets. And that contributed massively to all this volume that that appeared over the past couple of months. And it's decreasing right now because yield farming has died down a little bit. But still, a very, very interesting concept. And this is all possible because of that composability and the fact that all this stuff can automatically interact with each other if you build that bridge. And I just want to diverge for a second. David in the chat very notably also wrote out that Harvest was recently hacked for $24 million when they had about 1 billion or so locked in there. So don't take what I'm saying as like I got to jump into this because there's great APRs. There's also a lot of risk involved in doing so. I'm more so trying to show the narrative of what's going on behind the scenes of what's contributing to a lot of this volume and a lot of the things that are happening with it. So yeah, very, very interesting stuff though, how these things come together. And it's because Uniswap is an open protocol that can basically interact with anything because it's a smart contract that allows for these very interesting things to happen where Harvest Finance or Wire or other things can basically build on top of Uniswap's liquidity to offer a really interesting service.
Yeah, I mean, I find it super interesting that people call these things hacks. I mean, I get a little frustrated, not because like I mean, I understand where it comes from, but like at the end of the day, yeah, I mean, you go to the traditional markets, you go to the New York Stock Exchange, you go to NASDAQ, and you know, there's professional players playing that game, making way more than $24 million on a trade or on a arbitrage. And then there's an economic hack, if you even want to call it that, on something like Harvest, where really they found an arbitrage in the markets, in these automated markets. So it's not like, and I'm not advocating for people to do things malicious to other people by any means. I don't want people to be confused by what I'm trying to advocate for. What I'm trying to advocate for is understanding where the problem lies, or what the attack vector is for these types of issues, so that the people can hedge their own bets or learn how to make bets in the future so that they're protected, or they can make a gain themselves. So yeah, I mean, I think the issue really lies in the lack of the moving forward in free markets. So I'm a big believer in free markets. These markets will work all of this out, and there will be more insurance products. I love things like Open. I love things like Nexus Mutual, ways you can hedge your bet and actually bet on some of these, I'll call them bad things, from happening, so that you can be insured as an investor from these types of exploits or economic hacks, if you want to call them that.
So yeah, David, I think I agree with you totally on. I think what you were cautious about saying, I think I totally get what you mean though, and you're speaking not only from just as a believer in free market, but that is compatible with engineering too. I mean, engineering would say, hey, let's take this thing that happened that was not good as a learning experience and take everything we can from that so that it doesn't happen again. But as a market, what are we doing? We're adapting by looking more deeply at issues of trust, demanding from those who build Uniswap and anybody else or an independent party to filter things out for them so that they aren't made to prey. This is product market adapting to the changes that happen and the new risks that come out from previous innovations. And it's a cat and mouse game, but I mean, as you're alluding to here, I mean, this is we need to react like looking forward, because this is happening. It's not like it's going away.
Yeah, it's not like regulatory group bodies are going to come in and then understand this entire landscape and put in rules so that everybody's protected. Like, that's not happening. So like we should just figure out ways for the market to figure this out. And if people have the ability to bet on hacks or exploits happening, then they can be protected themselves. And that's why things like Open, things like prediction markets, like we were just talking about a minute ago. I mean, being able to go on a prediction market and say, will my liquidity pool lose a ton of value, and having a yes bet on that is, I mean, that's a huge insurance policy for people putting in $20, $100, $1,000 into these pools.
Right. And it diversifies risks for the individual consumer as well, because if you have an open system, then it's not necessarily reliant on a person to put out $10,000 or more necessarily for a venture that they would back, for example, or their governance token, but maybe $1 coming from 20 million people, or and where that will escalate, say 5 years from then, what the norm would be. I mean, that if governments were to try to regulate that, it wouldn't make much sense. It was like when they tried regulating music distribution, copyrights. Now we have like streaming services and everything. Like everyone basically just accepted, okay, if we push too hard, this will just go underground, file sharing will go up, and then there's nothing we can do. So we might as well say, okay, the old days are over, something has changed, let's adapt to this new technology and the new market that is acclimated toward it. Otherwise, we lost them and then we've lost completely. So yeah, just as much as you can't stop people from going online, and whether it's a dark web or whether it's just purely GitHub repositories sharing stuff with each other, you'd rather they do it in a way that everybody benefits and you know, makes sense. So I think we'll start to see a turn of the tide and not too much, I think, fear around the future of the industry, because it's just it's not a matter of if, but when.
Yeah. So David, you kept dropping like the A-bomb of arbitrage, right? Talking about who was it that got hacked? Was it Harvest, right?
Yeah, Harvest.
Right. So for those who don't really know what arbitraging actually is, right? How does that work exactly? Give us the rundown what that means exactly in the most simplest terms.
Yeah, I mean, there's a lot of different arbitrage, I guess, strategies, if you want to call them that. At a high level, arbitrage is the difference in taking advantage of the difference in two markets that exist at the exact same time. Whether that's, that can happen in the traditional markets, as I was describing, or in blockchain, it's usually the difference in price between two exchanges or two automated markets. Or, I mean, there's a lot of groups that are arbitraging the difference between decentralized exchanges and centralized exchanges. So it's really any economic difference in the value of the same assets across markets and taking advantage of that delta in the rate that those assets are exchanged. In terms of Harvest Finance, I believe they're going by, that a specific exploit was very complex, using several transactions to the Ethereum blockchain to be included in one block. Lots of gas was paid by the user to execute that. I believe even some flash loans were used, meaning they borrowed money from some provider, whether that's Aave or DYDX or some group that provides a flash loan, which is a ton of value, so long it's returned in the same block. So, you could borrow $1 million from a wallet so long as that it's returned in the exact same block, allowing you to execute a whole bunch of other transactions atomically at the exact same time.
It's within the same transaction, not the same block. It's a slight nuance difference, but same thing though.
Yeah, I mean, they have to be atomic, so they have to basically all occur instantaneously. So yeah, I mean, that's the that is an extreme example or a very advanced example of an exploit or arbitrage across some of these automated markets. But I guess what I going back to the previous part of the conversation, my viewpoint or my argument is really that we need more markets, we need more options for people to, or even built-in options, insured policies as part of these tools, which will become industry standard. I mean, it's creative destruction we're seeing at a pace that's just almost mind-boggling. The advancement of these products, these things, insurance, are just going to become standard in these products. You need to have an insured offering for your users, or the next group is just going to have an insured offering that's that much better. So, I mean, as the industry evolves, I think that arbitrage plays a critical role in healthy markets, but also protections for end users provided by other market participants who can extract that value in an economic way for all participants.
Love it. If no one has anything else to add, I know we're coming close to wrapping up our time. I kind of just want to go down the line again, starting with David, Kevin, and Corey. Tell us again where we can find you, your projects one more time, and then we'll break it off to networking.
Yeah, I mean, I beg everybody, please check out PrimeDAO. You can go to primedao.io to see our project in building sustainable DeFi products. And we're building a builders collective of individuals and other organizations that want to help and participate in the Prime Collective, and we're active today. We have a DAO up on XDAI, and it's very exciting. So come join us. I'll put it in the chat as well. And thank you for having me, Adam and Kevin and Corey. Thanks for being here too.
Awesome, Kevin. You're on mute. There you go.
Second time. Fooled me twice. So yeah, you can go to stable.tech to see the whole network of projects coming out from stuff we're doing. USDTZ.com, that's our main product and release. And that's tradable for liquidity pools on Dexter.exchange. It's one of 2 pools that are on. So Dexter.exchange is the first automated market maker that's made by CamelCase. And there are 2 liquidity pools there, TZBTC XTZ and mine, USDTZ XTZ. So, you know, if it's a big, complicated world of a million pools to choose from, you know, it's pretty simple right now. And, you know, maybe that means something. So click, I'm reading the thing that I was typing in the chat. What am I saying? Yeah, so you can contact me. I'm on Twitter at Mehrabi. That's my handle. You can also LinkedIn. I'll put those links in the chat as well. And yeah, feel free to ask me any questions. I'll be in the small room if you have questions about liquidity pools on Tezos, Tezos DeFi in general, the stablecoins coming up, or the Tezos Bridge or the lending system, Tezos Finance.
Awesome. And last but not least, Corey, where can we find you? Where can we learn more?
So you can find DeFi Money Market or DMM at DeFiMoneyMarket.com. Very nice and easy. You can find me on Twitter at CoreyCaplan3. And yeah, we also have a Telegram for more live discussion and Discord as well, whatever pick your poison sort of thing. But yeah, I also wanted to thank Adam for hosting it, and David and Kevin. This has also been a lot of fun.
Cool, guys. All right, before we end the discussion, we're going to transition out to the networking mode. For those who are new to Blockchain and Booze, make sure to have your mics on. Make sure to have your cameras on. Otherwise, you're going to be ridiculously confused. So I'm going to break it off into presentation mode. We're all going to disperse to these colorful tables where we'll be able to kind of meet and interact with all these viewers and participants that have joined us today. So without further ado, guys, thank you so much again. We'll see you next week. Bye-bye.